Our guest today is Ankur Crawford. Ankur is an executive vice president and portfolio manager at Fred Alger Management. Ankur has been featured and quoted in Investors Business Daily, Fortune, CNBC, and Bloomberg News.
I don't think that the AI stocks are overvalued.
So how far into the AI cycle are we right now?
We are so early, Margarita. We are so incredibly early. Maybe we're in the first inning of a baseball game or the first 10% of the game. Is when software begins to write software. The innovation curve becomes exponential.
How do you train your mind to handle the volatility that always exists in the market?
It's only once or twice a year you get a chance to distinguish yourself because the market gives you that opportunity.
Hello and welcome to the Investing and Other Stories podcast. I'm Margarita Triantafilido, your host and founder of Finance Latte, an investing education platform. The information on this podcast is for informational purposes only and should not be considered investment advice. Stay tuned for more important disclosures at the end of this episode. And lastly, a big thank you to our sponsor, finchat.io, your go-to place for stock market analytics and AI tools. Our guest today is Ankur Crawford. Ankur is an executive vice president and portfolio manager at Fred Alger Management, based in New York City. Ankur co-manages several strategies, including the Alger Capital Appreciation Fund, and is the sole manager of the Alger Concentrated Equity Strategy, which was launched in 2024. Ankur has 20 years of investing experience. Prior to joining Alger in 2004, she worked as an engineer at Intel and earned a PhD in material science and engineering from Stanford. Ankur has been featured and quoted in Investors Business Daily, Fortune, CNBC, and Bloomberg News. In 2020, Ankur was recognized as a top women in asset management honoree by Money Management Executive. What a career! And personally, I've had the privilege of meeting Ankur during my Wall Street career, and dear listeners, I can tell you that Ankur always stood out amongst the more than 1,000 managers I've met with, always bringing fresh and deep insights, even for the world's most heavily followed companies. Ankur, it's a great to see you again and a warm welcome to our podcast.
So wonderful to be here with you, Margarita.
I'm so excited about our conversation. Let's get started. I want to start with your a little bit unconventional background prior to entering money management. And can you tell us about your upbringing, exposure to different cultures, and of course, your STEM background and education before getting into money management?
So just briefly, I've actually spent much of my childhood all over the world. I was born in Kansas. And from Kansas, at some point, my family moved to Saudi Arabia. From there, I was shipped to boarding school in India. And then at some point got brought back to the US when I was 12. So by the time I was 12, I had already been exposed to a wide swath of people, religions, cultures, and had a very kind of unique childhood in that perspective. I mention it because I think it just filters the way I view the world in general. The portfolios, the way I think about businesses, I have part of that in me still of understanding kind of different companies, different cultures, different environments. After that, finished my schooling in Buffalo, New York, and I got a degree in material science and mechanical engineering at Berkeley. Decided I didn't know enough about materials and got a master's and a PhD in material science and engineering from Stanford. At which point I joined Alger, knowing not one thing about investing.
What made you apply? I'm so curious.
Oh gosh, Margarita, it's funny. I was 28 years old and I'd finished all this schooling and I realized I just wasn't happy. And at some point, my dad would always say to me, well, work is work because it's work, right? They don't call it play, they call it work. And I had realized I don't want to live my life just working. I wanted my work to also be something that I love to do, so it doesn't feel like work, because who wants to spend 12 hours a day working and not living?
Exactly.
So I decided I was going to try something totally different. I didn't know if I would love it or not, but I did. I had to take that risk, and that was the right time to do it. So I tried. I fully expected to go back and become an engineer at Intel or go be a professor somewhere, and I ended up staying for 20 years.
I love it, especially because there's such a misconception that people always wanted to do finance, that since an early age, they kind of knew maybe they were good at math and they envisioned themselves as going into finance. And I think that's such a myth that doesn't really happen. A lot of people just either stumble into it or get curious about it later on. So I'm glad to hear that it happened later on for you as well. And I do have to ask, once you entered the industry, what did you like about it? Why did you stay?
Oh gosh, when you think about the market and studying businesses, it's exciting for your mind because it changes every day. And there's no day that is like another day. There are similar patterns, but there's always something that's different, whether it's macro, whether it's geopolitical, whether it's product cycles, whether it's AI, and trying to stay ahead of it and understanding these businesses is not only really fun, but it kind of helps you think through what our lives are going to be like 5 years from now and 10 years from now, and the path of humanity, which I kind of find a really intriguing aspect as well. One of the things that I love about our business is that there is never stagnation in terms of learning. It is a business where no matter how many years you spend, you will always be learning and going up a learning curve. And those learning curves are going to be different. And really, the more time you spend, the more you realize you don't know anything. So,
I love it. And I always think of finance that you understand the world better. And it echoes what you said, that there's always something new to learn. And I do have to ask, you entered the industry about 20 years ago. So did you expect to maybe find the sort of Gordon Gekko, like the Michael Douglas character in Wall Street, maybe?
Margarita, I actually had no expectations because I had
Mm.
no idea what it meant. I had done an internship at Merrill Lynch with emerging markets debt group, and it was very, very different. It was just a 3-month internship. I had no expectations as to what to expect. So I don't know. I had never thought about what it should be. I had underpromised it to myself, and so it over delivered to me.
Wonderful. And when I think a lot of the analysts I've seen on Wall Street, a lot of them have the sort of typical career path, maybe business degree, and then they start covering tech. But you come from a completely different side. You come from the academic side. How do you think that plays into your role, and how do you leverage that academic experience?
First of all, for me, I did aspire to be a professor. And I carry that with me still in that I do like to explain and teach people. And it's a really important aspect of what I like to do, of making sure that some of our younger talent is kind of moving up the learning curve and coming up with great ideas and sharing it with them. In that way, or even when we're discussing a company or the nuances of a company, trying to view it almost from like a academic perspective of let's strategize where this should go. How should this company be positioned for the next decade? And some of that thinking is somewhat academic because it's not really affecting the day to day of the stock market today,
Mhm.
but has big impacts later. I would say that is a big influence on how academics have affected me as an investor, of trying to dig and learn about these businesses and where they're going to understand their end point.
Exactly. So you are a portfolio manager. You manage funds and portfolios either on your own or with your core portfolio manager. Can you describe to our audience, which mostly comprises of professionals outside the finance industry, what the typical day looks like for you?
As I said before, like there is no typical day, but I will try. Maybe give you a list of everything that goes on, and then there's shades of this through every day. I wake up at 5:30 in the morning and I start working. I usually work 5:30 to 7, and then at 7 I'm the human alarm clock in my house, and I have to wake up my 3 kids. And I have to get them ready for school and make sure that they're out of the house and not late for school. So I go into mom mode from 7 to 8. And that's when it starts to vary quite a bit, where during earnings season, there's going to be earnings calls and earnings that are hitting. Otherwise, there's generally news overnight or reports that are being written that come overnight that may be interesting and maybe they're not. But just perusing the street research takes up some of my morning. I work with our analysts pretty closely. Sometimes the schedule is packed with just analyst meetings where analysts are coming in and we're going through models.
You say you work on the models, and that is the financial models you use for each company you cover, correct?
Yeah, so these are just business models that we create that are a numerical reflection of a business that we are invested in or want to invest in or are interested in. And so it's an Excel spreadsheet that has things like revenue and profit, margin, their kind of how they get their revenue. So for Apple, for example, it will be the number of iPhones you sell times the price, and that composes the revenue. Very simplistically. Oftentimes inside these models, there are nuances that in fact are very important to the understanding of and to the thesis of the company. And those nuances are where we spend a lot of our time, or trying to find ways by which to enhance our understanding of the revenue line or the margin line or something about the company is where we spend a lot of time. Or it could be how an industry is changing. So, for example, a couple of years ago, I got very bullish on nuclear. And so there was a lot of discussion that I had with my analyst about, well, where can nuclear go and why should it do this? And the fundamentals of studying things like just studying the basics of fission and what happens in a nuclear reactor and understanding things as basic as that. That will be part of my day as well. And trying to model what that means.
Exactly.
So when I talk about models, that's really what I mean.
Wonderful explanation. Thank you.
Besides that, it's trying to have trying to figure out how to position portfolios. There's a lot of collaborative effort. There's a lot of discussion that goes on all day long between the portfolio managers and the analysts about different companies, the impact of something that might be going on in the world today on the companies that we own or that we want to own.
Great.
So then I guess I go home.
You're allowed to after a point. My next question is about mindset. I wanted to ask you, what mindset do you need as a growth investor? The market often gets carried away, hot trends, and it might overvalue some growth stocks. We've seen anything really after ChatGPT came out. Some of the areas of the market got really overheated, and such as anything AI related. I want to ask you, how do you handle this type of risk? And risk can take many shapes or forms, but I am talking specifically at owning stocks that might look really expensive on very simplistic traditional valuation methods like a PE, price to earnings ratio.
Yeah, so before we move forward, I would like to amend your question a little bit in that I don't think that the AI stocks are overvalued. If you look at where many of them are trading, they are actually not egregious. We've seen this big increase in the price, but the numbers have also come up tenfold. The multiple has actually compressed over that period of time. You look at what's going on with Microsoft, the multiple has compressed over the last 9 months because it's actually flat. So I don't actually think that the AI stocks are overvalued today. However, I think the essence of your question is, what kind of mindset do you have to have as a growth investor? First of all, when we are thinking about growth, you clearly have to have a mindset of thinking long and thinking about where our businesses and where our world is going, not tomorrow, not in the next month, but what is a trajectory over the next 2 or 3 or 4 or 5 years? And who are the winners at that end? So you have to have this long-term mindset, one that is also bounded by discipline. So when valuations do get frothy, and the most recent example of this was during COVID, the end of 2021, right before the Fed started to raise interest rates, the valuations had gotten quite out of hand. And to have the discipline to say, you know what, I'm going to step away from these valuations because they're baking in an endpoint is significantly better than where I think the world is going to be. And just to have that discipline. So it's this mix of confidence and long-term mindset bounded again by discipline.
And I do want to ask a quick follow-up here because I also talk a lot about long-term and ignoring the day-to-day variations, but how far out are we looking at? When you look at, let's say, your models or your time horizon, how far out are you literally looking at?
So it depends. There are certain companies that you really shouldn't be looking out more than a couple of years because of cyclicality. Those companies to me are just not interesting. However, there are other companies that you're going to be looking out 3, 4, and 5 years. And my favorite price target to look at is a 3-year price target, which would be based on 3 to 4 year out earnings. And because it really allows you to think about where the company can grow to and what kind of margin potential, what kind of revenue potential a company has, and understanding what that earnings power is. There's many good things about growth investing, but one of the parts that I find so elegant, Margarita, about growth investing is that a growth company, let's hypothetically say there's a company that grows 20% a year, and every year you grow 20% year in, year out, and you have that kind of stability. Well, if one year the stock stays flat, what happens in that year? The multiple compresses by 20%. Or what if it stays flat for 2 years? The multiple then compresses by 40%. So, provided the business model doesn't change, it's just a matter of time that the company will begin to respond to better numbers. And I liken it to a coiled spring, where the longer a growth company is flat to down, provided the business model doesn't change, you start to store energy as you might store in a coiled spring. And eventually, what happens when you let that spring go? It flies, right? It shoots across the room. And so when I think about growth companies, oftentimes time actually helps you. It's a benefit to growth investing, which allows you to have that long-term mindset as well.
That's a great analogy. It makes perfect sense. So since I left New York, I speak to a lot of people who actually have never invested before. And I keep hearing the same mental obstacle that keeps some of them from investing, the fear of losing money. How do you train your mind to handle the volatility that always exists in the markets?
As I've done this for a living, I've been through many different cycles. And what I have learned, probably the first time I had to ride through a cycle, I was frightened because I didn't recognize the patterns of what could happen. The second time you go through a cycle, you are still frightened, but are aware that some of these valuation frameworks will catch you. And the market or the cash flow will catch you and will catch the bottom of the stocks. And so as you develop the muscle memory over a long career, I think you start to recognize the patterns. And honestly, now when the market sells off, it doesn't always feel good, but there's also a sense of opportunity and excitement. Because when I came here, Dan Chung, our CEO, had actually said something that David Alger, who was our former CEO, had said. And he said that it's only once or twice a year you get a chance to distinguish yourself because the market gives you that opportunity. And if you act on those opportunities, you'll basically be a fantastic investor. And what I have found is that that is definitively true. It's like once or twice a year, you get the opportunity. With the volatility is actually opportunity. And so like this past August, I remember it was a very volatile August. And a lot of our growth names were just getting pummeled. And I was sitting there. Yes, it didn't feel great. But at the same time, I was quite excited because it didn't make any sense as to where these companies were trading. So with the volatility, instead of thinking about a loss, if you flip that narrative in your head from a negative one to one of opportunity. Volatility is opportunity, not necessarily something to be scared of. I mean, I will remind you that if you look at the S&P's returns over the last 20 years have been on the order of 11%. And so any kind of volatility that you get during the course of that period of time will quickly be compensated for by the growth of the S&P or the growth of the market. And if we look at the Russell 1000 growth, which are growth indices where you have a lot of innovative companies, the returns are going to be even higher. I think keep those two things in mind, that the return potential is much higher because of the compounding nature of growth. but also these tend to be opportunities.
I love it. Volatility equals opportunity. We will take that lesson. And we already started touching on AI, but I would love to ask you a few more questions on that because otherwise our listeners would never forgive me given your incredible expertise. So how far into the AI cycle are we right now? And when you start thinking about sectors or maybe sub-industries, do you think there's one area more than others that will benefit the most from the next part?
We are so early, Margarita. Like, we are so incredibly early. I used to say we're in the locker room, and now I feel like maybe we're in the first inning of a baseball game or the first 10% of the game. One thing to remember in this AI cycle is we've talked about it a lot. Every single news media, the TV articles, all being written about AI, but we have just started. And where we are going for AI is going to blow everyone's mind. As we look back 10 years from now, our world and how we work will be so incredibly different from a very basic perspective, just to bring it down to something that we can all tangibly understand. Today, we have this phone where we have all our apps and we have to go through and push on apps and interact with our phone. What if I tell you that inside of 2 to 3 years, your phone will be your personal assistant? You will be able to tell it what to do and it will perform tasks for you. You will be able to harness an agent that will be able to go book flights for you or plan a trip to Greece for you. The mundane things that you do on a day-to-day basis. You can do this today, actually, where you can program a agent or a digital version of yourself to go and do tasks for you in Excel.
Mm-hmm.
So what happens when you get to a point where many of our tasks are automated? It becomes a completely different paradigm of how we interact with our world. If I start talking to my phone and I have a digital assistant, which I can now talk to, or it can recognize that I'm about to leave the house and I have a meeting at 9 o'clock, it can automatically call me a car or an Uber or a Lyft. But guess what happens? It completely commoditizes and abstracts me away from the app world.
Mm-hmm.
And you think about what that means. It means businesses that were created over the last 15 years as we got the mobility aspect in our hands with this phone. Well, do those business models start to crumble? Because all of a sudden, do they get commoditized in some way, shape, or form?
Mm-hmm.
So I actually think this next decade is going to be fascinating because there are going to be business models that were built that were the disruptors, and those disruptors will get disrupted. So what sectors benefit? I think it's equally important to understand what sectors are going to get disrupted because there is going to be a very wide disparity between the two. The winners of yesterday that become the losers of tomorrow, new companies that become the winners, and current companies that can cross the chasm. And I think the winners exist across every single sector. I think there are some sectors that will be challenged, potentially things in software, things that don't have tangible assets. And we wrote a great paper on this called AI and the Declining Cost to Create that kind of goes through the logic behind what is happening and what could potentially happen. Or at least it was my kind of thought process on what happens when AI really comes in full force to software and to semis. So we wrote that maybe a year and a half ago. Every sector is going to benefit or be harmed. And one has to ask, how will that really come and play? And what companies are truly adopting AI front foot forward? Because if you don't adopt AI, you will die.
Mm-hmm.
I don't say that to be alarmist. It's absolutely true.
Mm-hmm. I do want to ask about that piece that you referenced. I believe you wrote that AI is going to write the software, right? That's what you were referring to with disruption part. And how far are we from that reality when it comes to the software side?
Oh, Margarita, it's happening today.
It's happening.
Just yesterday, I saw something that if you went onto Claude, you can create an agent that makes a website for you. You have to say, I want to make a website. If you don't have Python installed, it will go find Python for you, install it for you. It will bring the code onto HTML so you can have a website. It will do everything for you. It will write the code for your website. And again, this is just version 1. What happens in version 3, 4, and 5?
Exactly.
So you can get really sophisticated code writing in those versions. I think that the hard part to conceptualize is when software begins to write software, the innovation curve becomes exponential. And what can then be created has no bounds, because the only thing that you're limited by is how fast the software can write the software. And look, the software is defined by throughput of how fast your transistors work. They don't have to go out for lunch. They don't need to celebrate holidays, and it doesn't need to sleep. And so as innovation becomes exponential, what is the impact on businesses and our world today? I think that is the really fascinating topic that I am really trying to get my hands around, because it will dictate what kinds of companies will survive and what kinds of companies won't.
I love it. And it's really hard to grasp, as you said. So coming to terms with that and understanding it and the business implications, it's absolutely crucial, as you said. Thank you for sharing.
I do love these questions on AI, Margarita, because I feel like it is underhyped with the general public. I don't think the general audiences actually understand how much change is about to occur. And, and they can actually ready themselves. Now, for the first time, we can all educate. There's so many online free resources of what people can do to increase their AI intelligence or their AI skills. It's a real transition for society as well.
Absolutely. Is there a principle or motto that you live by?
One thing I've always tried to be is just be purely authentic to me and to my value system. That's a really important aspect of how I live my life. Work hard and be authentic.
I love it. One business related question. I saw recently that you launched the ETF. It's a new strategy, but in an ETF format. And I'm clarifying for our listeners that this is actively managed, as most ETFs are passive. Yeah. But can you tell us why offer it in that ETF wrapper? I'm just curious.
Oh my gosh, Margarita, there was overwhelming demand from some of our clients to offer an ETF. And in part because the tax implications for an ETF are significantly better. The ticker symbol on the ETF is CNEQ. But I think another reason is that we are limited by these rules called the 40 Act rules. And these rules limit the position sizes that we can take, which hamper the ability to trade around some of the big positions like NVIDIA or Microsoft. And by classifying this fund as a non-diversified fund, I now have the ability to trade around some of those bigger positions and add to positions and take away from positions versus having to just be stagnant. That was an important aspect as well. We know that we have to disrupt ourselves, so we also have introduced this ETF at a lower fee structure. And last but not least, it's a 20 to 30 stock portfolio. And instead of 50 or 70 stocks, we wanted to just put our best foot forward for our clients. They asked for it, and we're providing what they asked for.
Makes perfect sense to me, both from the structure, as you said, having a more tax efficient vehicle and making it more concentrated makes perfect sense. So excited to see and monitor that. Now, I do want to ask one question that has been on my mind. Only 2% of mutual funds in the US had a female-only PM. And that number resembles the 2% of capital that goes to female-only businesses. And there is that study from Harvard Business Review that showed part of the problem is the venture capitalists ask more restrictive questions to women, always talking about losses, while to men, they're talking more about what is your potential for gains? That is one factor that influences the outcome. So I have to ask you, do you think that institutional investors the people who you pitch your strategies to ask you more risk-related questions compared maybe to what they ask your co-portfolio manager?
Margarita, I haven't noticed that, but I would say that we do have a lovely set of clients, of institutional clients that also know me very well. So just like I met you 10 years ago, and we developed a relationship, a lot of our clients and I also have a relationship where I think some of the biases, if they did have any, and that I didn't notice, they probably fell away as they've gotten to know me. So I don't notice a difference, but that doesn't mean that there's not things that just work against women in our industry. We try and hire as many women as we can, and they're all incredibly capable, but it's really hard to hold on to them. And in part, many of them actually just leave the industry. And it breaks my heart because some of them are so incredibly capable. And, they don't like being the only female around the table. They feel like they don't have the same voice. They feel like they don't have the same support in the industry, not at Alger. I think Alger is a unique platform in this way where we are incredibly, and I have been incredibly supported, but it's not easy. And as life moves on, it doesn't get easier. It is a problem. I don't know how to solve it. And the only way I can think of solving it is just being a visible leader to show other young women. Like I never had a female to look up to as I was growing up in the industry because there were none. So the only thing that we can do is be leaders in the industry and show other young women that it can be done. Now, I will also say my career success is not, I didn't do it by myself. I've had incredibly supportive parents and my husband's supportive. So I've had a lot of support as I've tried to balance both work and life. But it's tough. It's tough.
Thank you for sharing that. And thank you for sharing your viewpoint on some of the women exiting the industry. I absolutely agree with you about the role models part because I struggle with that as well. Who was my role model? It was hard to find. And just seeing you on Bloomberg News, it makes me so happy because it's those little things that over time add up because you keep seeing the role models and eventually it becomes the most natural thing to go into finance. And that brings me to my next question. What advice would you give to the younger women who are considering a career in finance?
I think find your voice, right? Make sure that you find your voice because it's the most important thing that you have. A lot of young women are incredibly intelligent. Voice that intelligence. It's okay. You don't have to be perfect. I think the other thing is that I've always felt kind of underestimated. And most women will go into a room and feel that way. Whether it's true or not, I do feel like a lot of women that I've talked to have felt underestimated. But you know what? Again, I feel like so much of this has to do with like the mental framework of how we think of it. So instead of it being a hindrance to your career path, it's your superpower. Because when you're underestimated and you continuously exceed expectations, that's your superpower. And you surprise to the upside over and over again, let them underestimate you. You go show them how awesome you are. Right? So don't let other people's view of you hinder your own view of yourself.
That is so fantastic. Thank you. Thank you for reframing that discomfort and turning it into a superpower. And lastly, Ankur, if you had to summarize 3 key tips you have for those who have already started investing or are about to, what would you say are your 3 key tips on investing?
Keep a long-term mindset. As you invest in what you believe in. Especially as if it's not your day-to-day job, like invest in truly what you believe in. And probably the most important thing about investing, Margarita, is humility. Make sure that you have enough humility to understand that you're going to be wrong. You're going to be wrong. If you're a fantastic investor, you're going to be wrong 40% of the time. So use those opportunities to not only learn, but use those opportunities to, again, rethink and think again about your perspectives. Those are the three things that I would leave you guys with.
So fantastic, especially coming from a successful investor like yourself, and this message that you're always learning. I think that can help people get into the mindset that mistakes are okay and are part of the process and the journey. So thank you so much for joining us on the podcast, Ankur, and for the deep insights you shared with our listeners.
Oh my God, it's been my pleasure, Margarita. It's been such a pleasure to talk to you again after all of these years.
So wonderful to see you again. And thank you all for listening to the Investing and Other Stories podcast. If you enjoyed this content, please take a moment to subscribe to and rate the podcast on Apple, Spotify, or wherever you get your podcasts. You can follow me, Margarita Triantafiliou, on LinkedIn, or Ankur Crawford on LinkedIn, and at Finance Latte on Instagram. Cheers and see you next time. The information provided on this podcast is for informational purposes only. It should not be considered investment advice. The opinions expressed on this podcast are as of the day of the recording and are subject to change without notice. The views and opinions of guests on this podcast are not necessarily those of Finance Latte AB or its host Margarita Triantafiliou, collectively referred to as Finance Latte. Finance Latte is not affiliated with its guests or their affiliates unless otherwise stated. Finance Latte does not guarantee the accuracy or the completeness of the data presented herein. The information on this podcast is for informational purposes only, and the information, data, analysis, and opinions it includes should not be considered investment advice or tax advice, and is therefore not an offer to buy or sell a security. Finance Latte AB is not responsible for damages or other losses resulting from or related to the information, data, analysis, or opinions in the recording. Past performance does not guarantee future results. All investments are subject to investment risk, including loss of principal. Individuals should consider their own unique needs and circumstances and objectives before making investment decisions. Please consult with a tax or financial advisor for advice specific to your individual circumstances.